You start making a little more money, but somehow your bank account doesn't reflect it. Your earnings are quietly draining away through inflated living costs and compounding high-interest consumer debt. A flat checklist of financial habits is paralyzing because it lacks a logical order of operations. Without a clear priority, most people apply the right advice at the wrong time. It makes zero sense to spend your weekends researching complex corporate tax structures if you are still carrying a balance on a credit card at 22% interest. Building wealth is mathematically impossible if you skip steps. You have to plug the capital leaks in your baseline before you attempt to multiply your assets. This diagram is the wealth sequencing roadmap. It breaks your financial journey into 3 distinct zones: a red zone for debt and your baseline, a yellow zone for accumulation, and a green zone for multiplication. Phase 1 is your defensive baseline. Here, your sole focus is halting bad debt and automating a safety net. The final phase is offensive growth. This is where you leverage your capital for infinite upside activities like investing and tax optimization. But notice the hard barrier between the two. Following this map requires a strict trade-off. You sacrifice the comfort of immediate lifestyle gratification today to reach the full potential of compound growth tomorrow. The foundation of that first defensive phase starts with a single habit: paying yourself first. This concept was heavily popularized by Robert Kiyosaki in his book Rich Dad, Poor Dad. The common mistake is paying your rent, your phone bill, and your subscriptions the moment your paycheck clears, and only saving what is left over. The wealthy route a strict minimum of 10% into a savings account before a single bill gets paid. By treating that 10% like an unbreakable, mandatory bill, you guarantee the creation of a required 6-month financial buffer. This chart illustrates the second defensive requirement, treating bad debt as a mathematical emergency. While the stock market averages an 8 to 10% return, the average credit card interest rate is 22%. That interest cost effectively cancels out any growth you could achieve elsewhere. The rule here is absolute. Unless you can buy a consumer item outright in cash, you cannot afford it. Financing clothes or presents introduces a mathematical leak that actively destroys wealth. Completing this baseline demands an immediate structural downgrade in your current lifestyle comfort. You are going to have to forfeit short-term social spending to buy your way out of the red zone. This graph shows what happens when you fail to monitor spending. As income rises on the horizontal axis, wealth accumulation stays flat. This is lifestyle inflation. You make more money, so you buy a bigger house. Your spending rises in lockstep with your paycheck. To break this cycle, you have to track your income and expenses rigorously. Seeing those numbers in black and white is what actually triggers behavioral change. The trade-off here is psychological. Tracking every dollar is highly tedious, and it forces a direct confrontation with uncomfortable realities about your personal spending. But until you halt your lifestyle inflation, the surplus capital you need to fund your offensive growth will never materialize. You will remain permanently trapped in the baseline phase. Look at this comparison matrix. On the left, defensive saving hits a hard mathematical ceiling. You can only cut your expenses so much. But on the right, offensive habits like generating income and leveraging assets form an upward exponential curve with unlimited potential. Once you have your baseline secure, hoarding extra cash in a traditional bank account guarantees a steady loss of purchasing power every year due to inflation. To combat inflation, you must move capital beyond your 6-month buffer into diversified investments, forcing your money to work independently. The other major drain is taxes. The wealthy minimize this burden by utilizing legal financial structures. By deploying your capital through sheltered accounts like a Roth IRA or an ISA, you insulate your dividends and profits from being eroded by those tax rules. The required trade-off for this offensive growth is risk and effort. You have to trade the perceived safety of a savings account for market volatility and commit serious hours to building your own financial literacy. This decision tree maps your sequence. Have consumer debt? Ignore the stock market. 22% interest doubles market returns. Automate 10% savings and kill debt. Income rising, wealth stagnant? Track expenses, optimize taxes. Buffer saved? Move cash into diversified portfolios. Wealth building requires deploying effort against the specific mathematical leak holding you back right now, rather than adopting every habit at once. You have to constantly weigh the mental bandwidth spent pinching pennies against the energy required to learn advanced offensive strategies. Achieving financial freedom is a strict exchange. You abandon the comfort of immediate consumption today, specifically so you can buy back total autonomy over your time tomorrow.